Hello again, everybody. It is Friday, May the 7th. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important and influential charts and data series for the upcoming week. Number 1, market internals. The Asbury 6 remains positive. Those that have been following me here on StockCharts know that the Asbury 6 is our own tactical model that we use to determine the day-to-day health of the market. We look at it in a sense as when you go to the doctor's office and he has that early in the visit battery of tests that he does. He checks your blood pressure. He takes your pulse. He listens to your heart and lungs. He checks your reflexes just to establish some baseline health for you. That's what we see the Asbury 6 is doing for the stock market. It's updated every day based on the close the previous day. People always ask folks like us who do this for a living, what's your favorite indicator? I don't have one because every indicator has an Achilles heel. That's why we built the Asbury 6. The Asbury 6 is 6 different indicators, and on purpose, only one of them has to do with the price of the S&P 500, the index, the level of the index, the S&P 500. The other 5 are what I'd call secondary indicators. Investor asset flows, volume, corporate bond spreads. The reason for that is because the markets, modern markets, current markets are driven on a day-to-day basis by a lot of computer trading, a lot of algorithmic trading. There's a lot of volatility day-to-day. The S&P might be up 30 points on Tuesday. It might be down 40 points on Wednesday, and then Thursday overnight, it's up 50. It's very easy to get your head turned around and start chasing the market and making a lot of mistakes. So what the Asbury 6 does is focuses on the internal health of the market as a primary focus. So you can see 5 of the 6 are currently positive or green, and these cells all have the dates that each of these individual components of the Asbury 6 went to positive. There's only one that's negative right now, and that's corporate bond spreads. The Asbury 6 has been positive since March the 11th. Since then, the benchmark S&P 500 has risen by 7.3%. 4 or more metrics in one direction indicate a directional bias, a directional signal. So this indicator has been telling us since the early to middle part of March that we should be invested. So the next question is, what do you invest in? We have a number of models that help us to determine places we're likely to get some outperformance. And by outperformance, I mean outperformance versus the S&P 500. And one of those is our SEAF model. SEAF stands for Sector ETF Asset Flows. So we're following the money in U.S. market sectors. Here's our SEAF model. It's updated once a week. It's updated on the weekend. And what this shows is, and what makes the model unique, is it isn't measuring the relative performance of the price of one of these sector ETFs versus another, but rather it's measuring the asset flows going back and forth between them. And it does that in 3 different time periods. Trading, which is weekly, tactical, which is monthly, and strategic, which is quarterly. The latest data show a continued trend of inflows into financials. That trend started on 11/12 or November the 12th. So that's been with us for some time. And also a new trend of inflows into energy. So that tells us, since we're in a risk-on situation according to the Asbury 6, the money is going into financials, and most recently it's also going into energy. It also tells us where the money's coming from. A trend of outflows from consumer staples since November the 25th, healthcare since March 25th, and technology most recently since April 22nd. So we want to avoid these and try to go into those sectors, buy stocks or buy the sector ETFs in the places where the money's going, so we've got some wind at our back. Now our next chart, number 3, takes a look at the financials sector and shows the relationship between these asset flows and performance, outperforming since November. So here's that chart. We've got the XLF, which is the financial sector SPDR ETF since November, up top here along with its 200-day moving average, which most people look at as being the major trend. And down here we have the daily relative performance of XLF versus SPY, which is of course the S&P 500 ETF. And then underneath that we have our 63-day moving average. 63 days is one business quarter. That's a strategic time period. So since SEAF pointed out XLF as being an overweight for us, XLF has risen by 40% and simultaneously outperformed the S&P 500 by 18%. So that's the relationship between asset flows and performance. As long as XLF continues to show up on our SEAF model, we're going to stay overweight. If that shifts and goes somewhere else, we follow that money and we will get out of XLF and we will follow the next trend of asset flows. So all we're doing is we're surfing trends of money. We're not trying to be fortune tellers and predict how interest rates may be in 6 months. We're following the money. Now, there's also some things to be aware of here. Technology, investor assets are leaving the QQQs, which is the ETF that tracks the NASDAQ 100. And here you see the NDX daily since December up top, and then the total net assets invested in the Qs, QQQ, and its 21-day moving average. Why the 21-day moving average? That's our tactical time frame. That's what we use to move in and out of the strategic trend that we talked about on the prior slide. So you see the daily total net assets invested in the Qs have been in a tactical trend of contraction since April the 30th right here. The last time that we had that type of trend from February 23rd to March 15th gave us all of this when everybody was worried we're going to go into a deeper correction. So we're starting to see that again. That's a warning flag to me. That tells me the leaders aren't leading here, and that could be problematic. So now our slide 5. So now we're looking at the relative performance driven by those asset flows. So now we've got the comp, the NASDAQ Composite Index, and that goes back to December. And we're also showing the March 2020 uptrend line and the 50-day moving average, which a lot of people see as being the minor trend. You can see we're testing the moving average now. But here's relative performance now of comp versus SPY and that 63-day strategic moving average. The comp has been underperforming the S&P 500 on a 63-day or a quarterly basis, strategic for us, since February the 18th, which is right here. And we are making a new extreme in relative underperformance as of yesterday. So that tells me even though the A6 is positive and money's going in the financials, we're outperforming nicely, we're having a problem here with leadership. And you can see also the semiconductors who usually lead in a healthy bull market. They're underperforming. Small cap is underperforming. So even though we are currently risk on and we're overweight financials and we're doing quite well there, looking out over the horizon, we're seeing some clouds coming in. So you really need to pay attention to the leadership. The longer that tech, semis, and small cap continue to underperform, the harder it's going to be for the S&P 500 to keep its current trend to new highs. So there's your daily 5. Thanks for watching, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.